Okay, so what we're interested in is liquidity. Where is the money going to come from this year? If you want the real answer to where money comes from this year, it's not a guess, it's flow. As you can see here, money market funds are sitting about 7.7 trillion. That's not bullish or bearish by itself, it's telling you that a huge pool of capital is earning yield while it waits for conditions to stop getting worse. So the question becomes, what makes that pile of cash move? If we start with constraint, we can see that the US has roughly 38.49 trillion in debt outstanding, and that means the system is currently doing two things. First, it's rolling over debt, refinancing maturities. Second, it's funding deficits, so new insurance. And that's why the economy needs money, not emotionally but mechanically, because a high debt system can't tolerate sustained tightness because tightness raises the cost of carry across governments, banks and corporates. So policy doesn't have to announce stimulus to add support, it just needs to make sure that the machine can refinance without breaking. Now when people say money is coming, it usually means one of three things. First, fiscal flow, which is when the Treasury spends more than it taxes, and this is the cleanest non-opinion chart of this. As you can see here, the Treasury General Account, or the TGA, moves up and down. When Treasury builds its cash balance, it can be a drag. When Treasury runs it down and spends, that money shows up as deposits in the banking system. And second, we have bank credit, when loans create deposits. This is the part crypto people ignore, because most money creation happens via credit, not the Fed printing. When banks expand credit, deposit expands, and when credit tightens, liquidity tightens. Third, we have the Fed's plumbing, so reserves and cash parking. Now this is the plumbing dashboard, and as you can see here, reserves balances around 3.05 trillion on the last weekly average print. And this chart here, reverse repo, shows how much cash is being parked at the Fed instead of circulating. When reserves are stable and reverse repo is low, the system is usually less stressed than people think. Now here's the part that actually answers the why is everything moving question. When money is stabilizing rather than exploding, you get three different behaviors. As you can see in equities, stocks can grind higher because they have structural demand, whether that's passive flows, retirement allocation, or corporate demand. Commodities react to funding conditions, inventory cycles, and hedging demand. But crypto, especially anything outside of Bitcoin, usually needs incremental risk taking, not just stable liquidity, but a reason to leave cash and add volatility. So when stocks and commodities look strong but crypto feels slower, that isn't crypto is dead, it's a different demand engine and a different time frame. Something else that points to the fact of liquidity coming into the system this year is rate cuts. The lower the rate, the cheaper it is to borrow money and the more risk people usually take. And something we like to look at to gauge whether the Fed will or will not cut rates is inflation. As you can see here, core PCE inflation is running around 2.8% year over year as of November 2025. And the point isn't inflation is low, the point is it's not re-accelerating. That changes the policy reaction function. When inflation is ripping, policy has to restrict. When inflation is stable-ish, policy shifts to don't break the system. And in a $38 trillion debt world, don't break the system is basically the hidden mandate. Back onto the fiscal side, this is where markets stay sensitive to politics. Trump floated the tariff dividend type check idea, and that sent mixed signals on timing, and importantly, it still requires Congress. The takeaway isn't checks a guarantee, it's that political bias is towards supporting growth in households, not austerity. That means the baseline of 2026 is more insurance, more spending pressure, and more incentive to keep financial conditions from tightening too far. We also have to look at what Trump will do for the midterms. So for more of a direct answer, the money from the markets comes from reallocation of parked cash, ongoing fiscal deficits and refinancing, credit and plumbing management, and a policy environment where inflation is no longer forcing constant tightening. We also look at the rotation from gold and silver into assets like crypto, money moving down the risk curve as policies ease. That mix doesn't guarantee a straight line up, but it tells you the base case for 2026 is not liquidity gets tighter forever. It's liquidity stabilizes and the risk assets respond. Now, if you did enjoy the video and you want to be part of the daily conversations we have about macro environments and all different types of markets, I'll leave a link to the free Discord down below. You can also follow us on X for more takes and everything we like to talk about there. And if you did like the video, please leave a like and subscribe.